Welcome back. Today we're diving into a bullish analysis on Datavault AI, focusing on its Q3 earnings, that 148% revenue growth, and a really aggressive management forecast.
A forecast projecting revenue over $200 million in 2026.
Which is a potential 6,600% jump from 2024. It's staggering. And I think that's where the first issue comes up. The piece makes a strong case for future revenue, but it kind of hits a wall justifying the current net loss.
It does. And that's the first thing we need to tackle. You have to establish a clear operational link between the current infrastructure spending and the future capacity that's needed.
Right.
The weakness is that the analysis just attributes that, minus $33 million loss to aggressive infrastructure spending. But it doesn't show the reader what that money is actually building.
So the big number just sits there looking like a problem.
Exactly. It leaves that $200 million forecast feeling, aspirational instead of capacity-driven.
So the suggestion is to reframe that loss as a strategic investment. How do we do that?
You need to integrate the cost narrative directly with the scaling potential. Show what that spending enables.
Okay, so get really specific.
Very specific. For instance, don't just say they're spending money. Clarify how that spending is directly facilitating, say, the real-world asset tokenization for that big $125 million Triton Geothermal deal.
I see. Or you could detail how it increases the bandwidth for future data licensing, like that $10 million Scilex agreement?
Precisely. That way the loss is no longer just a loss. It's the cost of building the machine that generates the huge revenue spike. It's a direct connection.
That makes sense. Okay, so if we've now justified the investment thesis, we have to look at how the piece defends its recommendation against the risks it brings up right before the rating.
Yes, the speculative buy rating.
Yeah. It lists execution failure, dilution, and high cash burn, and then says speculative buy. It feels like it undercuts its own confidence.
It really does, and that brings us to the second point. To increase the conviction behind that speculative buy thesis, the material must proactively mitigate those identified risks.
Right.
The weakness here is that the risks are just listed out. It leaves the reader with these huge unanswered questions, which just weakens the persuasive power of that $3 plus fair value target.
So instead of just disclosing the risk, the analysis needs to kind of diffuse it for the reader, turn it into part of the model?
That's a great way to put it. Diffuse it. The suggestion is to turn those risks into demonstrable factors of operational diligence. Frame the solutions as achievable milestones.
Okay, so give me an example. What about dilution?
For dilution, don't just mention it's a risk. Clarify the expected financial impact when that API media acquisition closes in December.
Ah, so project the capital structure after the deal closes.
Exactly. So the reader knows the exact float they're buying into. Or for the high cash burn, you could project the financial runway needed to actually execute on those key deals, Triton, Scilex, and hit that $200 million guidance.
And that would add context to the current 1.60 stock price, defending it as a support level.
You got it. It's all about turning the potential negative into a calculated, manageable part of the thesis.
This is a really strong analysis, and these changes would just make it so much more credible.
Yeah, the bottom line is this. First, you have to transform that net loss from a liability into a strategic investment by linking it directly to the $200 million capacity.
Connect the spending to the outcome.
And second, you have to back up that speculative buy recommendation by showing a proactive, bulletproof plan to navigate the big risks, like dilution and cash burn. It really all comes down to building conviction.
Excellent advice. We're looking forward to seeing the revised version. Be sure to send your